Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the Property Twins. We are mortgage brokers and buyers agents, helping clients all over Australia build property portfolios. In this episode of Property Addicts Australia, we talk about the correct lender selection, maximizing the equity available to you, mapping out your property portfolios, moving from bank lenders to non-bank lenders. We also talk about maximizing the equity upfront so you can expand your property portfolio. Lastly, we talk about the right repayment types that help you maintain the tax effectiveness of your investment loans and making sure you pay off your owner-occupied debt as you build your property portfolio. The challenge we find in the finance and property space is that most people think of property first and then finance later, when it needs to be the other way around. You need to think of the finance first and then the property.
For the amount of times I have heard people say, well, I'll find the property and then I'll come to you for the finance piece. However, it needs to be switched the other way around. You need to have a clear understanding of your finance, have the funds ready to go before you look for a property, because how do you know then what you're looking for? If you're going looking for a property, for all you know, you're unable to finance it.
Well, property is just a vehicle to access finance, and especially if you're building a property portfolio, you need to map that out upfront, right? Looking at what your current resources are, how much equity you have, and map that out in terms of 1, 2, 3, 4 investment properties that you're able to do. And of course, this evolves over time. Lending never stays where it is. In a few years, this could change. But if you have a clear idea, that's like driving, right? On a road, on a highway, and you're driving at night and you can only see the next few hundred meters, and the GPS is what you need to go to your destination, but you only need to look the next few hundred meters to take that step, but you already know where the destination is. And that's why mapping out your portfolio is essential.
And as part of this process, you need to make sure that your loans are actually set up correctly, whether it be owner-occupied lending or investment lending or a mix of both, that you get the structures right so that you are maximizing tax efficiency, minimizing risk, and you're set up correctly to be able to make the most of your resources.
Yep. And if you're starting out, say today, you could obviously look at the interest rate or lender policy, but what will help you expand that portfolio is the flexibility a lender offers in terms of the equity they can release you, right? Some lenders are more flexible than others, right, in terms of the equity you can access to expand that.
So they may release hundreds of thousands of dollars worth of equity, which you could put toward one or multiple investment properties, depending on your goal. Whereas other lenders are quite inflexible in that they don't release the equity to you. They say, well, we are approving this equity cash out for you for your next property. However, you need to bring us the contract of sale for that property for us to actually fund that. And they also control that money. These lenders control that money and they don't give that to you. And imagine, you don't have borrowing capacity with your lender for your next property. Then you go do a pre-approval with another lender, and then you have to come back to your lender and say, well, could you please release the equity?
Or they may not.
They may decide not to at that point in time.
They might want to assess that you can actually afford that property before they do that. And I think it's lender selection is also prudent when you're paying lenders mortgage insurance. If you have a vision to build a property portfolio, and let's say you're just buying your home today, then choose a lender which gives you the flexibility to tap into the equity, because in the LMI, lenders mortgage insurance territory, not all lenders will release the equity to you either.
That's right. So I've had a number of clients where they've paid LMI on their owner-occupied property, and we strategically placed them with a lender which allowed them to later down the track tap into the equity and release that equity so that they could buy their first investment property. had they gone to a lender just purely based on the interest rate they were getting, they would not have been able to expand their portfolio because their property had not grown sufficiently to give them enough equity to refinance. So it paid off for them in those instances.
I think it's also important where lender flexibility is important. Let's say you don't even have equity, you haven't even built that equity. If you're building savings in parallel, not all lenders will be flexible enough for you to change the loan structure to use your savings tax effectively.
Debt recycle. So not all lenders would enable debt recycling, because I've had instances where clients have had loans with lenders who wouldn't even allow us to split a loan unless there was a full loan application. Now imagine if your life circumstances have changed and you're no longer serviced with that particular lender, and you can't even restructure that debt without having to put in a full loan application, then it could cost you tens of thousands of dollars in potential tax savings that you could have had down the track.
It's easy to just look at a lender on the surface than to set it up. And when building a portfolio, right, when mapping out that portfolio, we go to lenders in a specific order, from bank lenders moving on to non-bank lenders.
And even with bank lenders, borrowing capacity varies depending on the lender policy. So you may have more borrowing capacity with one lender, but not have the same borrowing capacity with another lender. So it's about going to lenders in an order where you're able to maximize your resources.
Well, with bank lenders, right, they are regulated by APRA. How bank lenders assess you is you might have an interest rate of 6%, and they will add 3% on top of that to assess you. So you're being assessed on 9%. So as you can see, the borrowing is significantly tighter with bank lenders. You exhaust that in the first instance, and then you go to non-bank lenders. Non-bank lenders treat it differently, your existing liabilities, for example.
That's right. So non-bank lenders look at your existing liabilities and they pick up actual repayments you may be making. For example, you might be making interest-only repayments for your loans. So they would take that actual figure into account rather than looking at the principal term, rather than putting a 3% buffer on top. So they look at that as is, which actually helps your borrowing capacity. And at times, they may not differentiate between your basic and your additional expenses as well. But something important to note is that once you have gone to lenders in an order, you're unable to go back to your original lender, because by that time you would have had extra lending and you may no longer service with your original bank. For that reason, it's so vital to be tapping into all the equity you're able to on the front end, and really having a strategic approach to all this.
You also need to consider, right, between bank and non-bank lenders, understandably, the rates are higher with non-banks, but you need to measure that up as to the growth of the property you will be achieving. Of course, you need cash buffers there to sustain any negative cash flow that might happen because of the higher interest rate. But non-bank lenders, we treat them as placeholder lenders. So you get into the market, you secure that property. Once the lending goes in cycles, right? Lending relaxes, you move them back to a bank lender and the cycle continues, right? We've had so many clients over the years who might have started with a non-bank lender to secure a property, and then we move them to a bank lender where the cash flow could improve, and then again tapping into that equity and going for the next property after that.
It's a cycle. It's really a cycle, and you can't judge it based on what you see now. Lending ebbs and flows, at times it's tight, other times it's lenient. So if under the current climate, all you can do is go to a non-bank lender and buy that property, then you need to just allow time. And also your income may go up down the track, or depending on your career aspirations. So your income may go up and you could refinance it at a later point in time. So at least by doing this, you expose yourself to the market. If that market grows, say 10%, you make that 10% gain you wouldn't have otherwise made.
Yep. And you touched on how once you've gone through lenders in a specific order, it's really hard to go back to that original lender unless life circumstances change significantly for you to go back and tap into that equity. So it's suggested best practice is to tap into that equity upfront. And time to time, clients are like, well, I can access $300,000 right now, but I'll only access $150K to buy that next $600K property. But what you're doing is you may not service for that lender anymore once you've bought that property. So make sure you tap into that equity, maximize that flexibility your bank lender is offering you.
And the idea is once you tap into that equity, provided you put that money in the offset account and the loan is interest only, you're not making any repayments and you're in full control of it, and you may choose to even pay it back down the track depending on what you end up deciding. But access it on the front end and then see where your resources can actually take you. You might be wanting to access equity and purchase 2 investment properties. Say, hypothetically, you have a property worth about $1 million and you owe $500,000 on it. So using the 80% loan to value ratio, you could take your loan up to 80% of $1 million, which is $800,000. You owe $500,000 on your home. So $800,000 minus $500,000 is $300,000 worth of equity that you could access.
But you would be ordering a couple of valuations for that upfront, right? Because not all banks will have the same value. You might be able to have 300 grand or a little bit less. But in this scenario, right, if you're wanting to buy 2 properties, 300K equity is what you'll be able to tap into should your valuation stack up to $1 million. And then looking at 2 600K properties, $300,000.
So ballpark, if you need 20% deposit, 5% for purchase cost for a 600 grand property, ballpark you might need about 150 grand depending on what state you're buying your property in. So with that, depending on the bank you're with, a bank may not want to release all the money to you. They may want to hold back the cash.
And that's why lender policy is very important to get control over your money. So it's deposited in your offset account.
That's right. So say hypothetically, the lender's not willing to release the money and say you buy 1 property and you may miss out on the second property purchase because these transactions take a while, right, to complete. By the time you're ready to buy your next property, life circumstances may have changed. Your life circumstances may have changed, or
valuations could have dropped as well.
Valuations, you may have to redo the paperwork. Valuation might have dropped of your home. Say hypothetically, in a market, like it might come back at $950,000 depending on how the market is tracking in that particular area. Then you're no longer able to expand your portfolio. You are no longer able to buy 2 properties.
Yep. That's why it's important spreading out those funds. You might only have servicing for that 1 purchase with the bank you're with, and then the second purchase being done with a non-bank lender or lower tier lender or yet another bank lender. It's a lot harder to go back to access that. So make sure that you have that control upfront, and that's why accessing equity upfront is essential. But map that out. 300K funds available, can do 2 investment properties. Here are the lenders you'll go with. And again, then you can decide the timing as to when you execute that portfolio.
That's right. And nothing is set in stone, right? Like whilst you have an idea and you have mapped that out on the front end, things could change. Lender calculators change all the time. Lender policies change all the time. So what you are able to do today might be different to 3 to 6 months down the track as well. So it's an ever-evolving thing. But you make decisions with the information you have at this point in time.
Yep. And focus on maximizing that opportunity. You also then need to consider the repayment type for those properties. So you might have an owner-occ and then you're buying 2 investment properties. Owner-occupied properties, typically principal and interest repayments, because that's non-tax deductible debt that you need to pay off.
That's right. However, you may have plans of converting that property into an investment property in the short to mid-term. Then you need to weigh up, is this the right repayment type for me? Should I actually be doing interest-only repayments because I'm going to convert this property into an investment property down the track? So you need to weigh up, and also it may depend on how much savings you have in an offset account. linked to your owner-occupied property. So your owner-occupied loan might be offset, for example, or bulk of it is being offset. Then you might as well do interest-only repayments. Then you don't have to make any repayments, and you build up buffers for your future home as a result.
Also depends what your future plans are. If you're looking at debt recycling those savings and converting your owner-occupied debt into investment debt tax effectively, of course, subject to your tax accountant to invest that in other asset classes. And then investment lending typically is interest only. There's a couple of reasons for that. The first is, one, maintaining that tax deductibility of that loan, because if you have an owner-occupied debt, that should be your priority to pay it off. Any tax benefits that you're getting on your investment property should be redirected to paying off your owner-occupied property. There's a reverse compounding effect to paying off or building more of your owner-occupied offset and saving on the interest on the investment or owner-occupied debt itself.
Well, I was doing a strategy for a client a couple of months ago where they had non-deductible debt on their owner-occupied debt, and they also had investment loans, and they were actually paying principal and interest repayments for their investment loans. Then we switched their investment loans into interest-only repayment from principal and interest. Given the size of lending that this individual had, the difference for them was paying off an extra $120,000 odd over the next 3 to 5 years against their home. And obviously they had to pay higher rates for interest-only lending, but that higher interest was tax deductible. But they were overall ahead by about $120,000 odd.
Well, it's a risk profile thing as well, right? When people say we want to pay principal and interest on all properties. Sure, understand the mindset of that, but what you need to see is what maximizes the most opportunity for you. It might need a little bit more thought around what helps you, maybe run it past your tax accountant as well as to best practice. But in terms of credit best practice, that's what we suggest our clients do to maximize that opportunity for them. Just to recap, in this episode, we talked about selecting the right lender, maximizing the equity available to you, and mapping out your property portfolio right from the start. If you're looking to build a property portfolio, now is a good time to make sure your loans are structured correctly so you can move from one property to the next and the one after that. Thanks for listening. Join us next time for another episode of Property Addicts Australia podcast.